Imagine yourself emerging from your career and gazing into the horizon of home ownership. The journey ahead is a series of financial decisions, discipline, and dreams marked by the daunting yet exciting realm of mortgages. Before your dream comes true, there's a challenge to tackle, the down payment hustle. These days, snagging a decent house in Malaysia costs around 550,000. So you're looking at coughing up at least 50,000 upfront if you're a first home buyer. Not exactly peanuts, right? Yet, this isn't always the most daunting aspect, since there's always the potential to receive support from friends and family, easing the challenge of raising these funds. But here's where another obstacle enters the scene, the question of affordability. In most scenarios, securing the bank's financial backing becomes necessary to secure a loan for the remaining 500,000 needed to seal the deal. That's a substantial amount of money, and based on current rates of about 4% and assuming a 30-year loan duration, you will need to allocate roughly 2,400 ringgit every month for repayments, stretching all the way to your retirement age. Now, in the banking system, there's this thing called debt service ratio, or DSR. Simply put, it is a comparison of your debt commitment to your total income. Generally speaking, a bank will accept your mortgage application if your DSR remains below 60% for all your debt commitments combined. So, if you are seeking a mortgage amount of 500,000 with monthly repayments of 2,400 ringgit, it's important that your monthly income surpasses the threshold of 7,500 ringgit. Let's get real for a second. Now, we all know that 7,500 isn't the most comfortable amount to survive in Malaysia, with prices keep escalating due to inflation. And jumping into a mortgage of this magnitude kind of changes the game. Suddenly, your leftover cash taking into account this mortgage drops to around 5,000 ringgit. And you're probably thinking, how am I going to sustain this for 30 years? Obviously, over time, our salaries will go up, but that's still a really heavy burden to carry in the long run. Furthermore, it's not like we just can walk into our boss's office and ask for a raise whenever we want to, right? Now, here comes the twist. What if I tell you there's a slick way to string your loan tenure without having to fork out one extra cent to do it? That's not even the best part. Since the loan tenure is reduced, that means you are also saving a lot on interest payment to the bank. To understand how this is done, first, we need to know how a mortgage works. When we borrow 500,000 from the bank at 4% interest for 30 years, on the day the bank disperses the money to us, interest will start counting and accruing. So on day one, the bank will charge 55 ringgit and 50 cent interest on our mortgage. This number is going to add on day by day, and by the time we reach the end of the month, we would have accrued a total amount of interest worth 1,667 ringgit. Now, keep that number in mind because we will come back to that. For a mortgage loan worth 500,000, the monthly installment is roughly 2,400, and that amount is split into two portions. The first portion is 1,667, which is the amount that we calculated earlier goes to interest payment, and that leaves us with the second portion of 733 ringgit to pay to the principal amount that we owe to the bank. The important point to note is that even though we have paid 2,400 to the bank, we are actually only paying off 733 ringgit on the principal and carrying forward 499,267 ringgit to the next month to repeat the process all over again. Just to make sure you totally get the point, let's continue with the example. As the loan moves on to the second month, instead of calculating the interest we need to pay to the bank based on the original loan amount of 500,000, the bank will now base it on the new balance amount of 499,267. Because the principal is lower, the interest payment is also lower. This time, it is 1,664 ringgit, which is 3 ringgit lesser compared to the first month. Because we are paying 3 ringgit less interest on month 2, the same 2,400 ringgit monthly installment can now pay 736 ringgit worth of principal. As times go by, we will pay less and less interest and more of the principal amount until the entire loan amount is completely paid off. And that's how a mortgage typically works. So how can we magically reduce the tenure of the loan and directly lower the total interest payable to the bank? You probably noticed by now that there are only a few parameters that influence the mortgage calculation. There's the loan amount, the interest rate, the loan tenure, and the frequency of payment. Most of the parameters are fixed when you enter the mortgage loan contract with the bank. But if your mortgage is a full flexi loan, it offers you the versatility to repay as and when you have extra cash, or at any time when you have the ability to pay, as long as you at least make the agreed minimum loan payment of 2,400 ringgit. Leveraging on that flexibility, you can now play around with the mathematical formula to your advantage. You see, whether you are jogging in the morning, doing the laundry in the afternoon, making dinner in the evening, or sleeping at night, the bank earns an interest on our loan every single moment. In order to limit the bank's ability to do that, the only way is to reduce the principal amount as soon as we can. When we pay our loan on a monthly basis, essentially what we are doing is allowing the bank to accumulate the interest charges based on a big lump sum amount of principal. Instead of paying once a month, maybe we can split our monthly payment into smaller chunks, say on a bi-weekly basis of 1,200 ringgit each time. This can help lower the big principal amount faster when we increase the payment frequency. And when that amount gets smaller, the interest on the bank charges also gets smaller. On top of that, since we will end up making 26 payments in a year of 52 weeks, we are actually making 13 monthly payments. That's 1 month extra every year without adding additional financial stress to what we have to pay originally. So on one hand, we lower the principal amount by increasing the frequency of payments to the bank, and on the other hand, we are indirectly paying 13 months worth of installments without stretching our financial limit. All in, this strategy will save you a staggering 47,240 ringgit worth of interest and shorten your loan tenure by 3 years and 8 months. That's great, right? Totally look like a plan towards financial freedom. So as you stand at the crossroad of dreams and mortgages, the journey might seem daunting, but armed with knowledge and strategic moves, you can craft your own financial freedom. By embracing the power of payment frequency, you are not just taking control of your loan, but sculpting a future that's lighter on the wallet and brighter with possibilities. But remember, the example above is totally simplified, and in real life situation, there might be additional factors to consider, such as fees and lender policies. It's also important to consult with your bank before making changes to your payment plan.